Coming up on Market to Market. Trade, energy, and manufacturing look to have starring roles in the 2017 economy. And looking back at the big stories of the past year, those stories and market analysis with Dan Hueber next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, December 30 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The end of the year brings time for reflection. A look at what was and what will be in the new year. 2016 was off to its worst two-week start ever on Wall Street. But as the ink dried on the presidential election results, the markets rocketed higher, flirting with the psychological threshold of 20,000 points. The broadest measure of the market, the S&P 500 index, rallied after a flat finish in 2015 to rise 10%. The Dow Jones, a measure of the daily price movements of the 30 largest American companies, is up nearly 14% on the year. The NASDAQ, an index of technology stocks, is running nearly 10% higher. And the snapshot of the smaller companies, the Russell 2000, zoomed ahead 20% in 2016. What happens on Wall Street doesn't always translate to Main Street. Peter Tubbs gets the outlook of two Midwestern economists for the next 365 days.
America's agricultural economy has both opportunity and potential risks in the year ahead, according to two Midwest economists. Ernie Goss of Creighton University and David Swenson of Iowa State University both view the trade policies of the incoming Trump administration as an important issue for rural states.
The U.S. depends heavily on agriculture, agricultural exports, and agriculture depends heavily on trade. You know, when your bite gets as bad as your bark, that's a problem.
If we start having trade wars or trade restrictions, we either increase the cost of buying stuff from Iowa or decrease our access to goods and services from other places. The whole idea of trade is that both sides are satisfied, not zero-sum game, that both sides think they're getting a good deal out of this. That's the nature of trade, not one side wins and another side loses. Right now, it's the language and the rhetoric is who are going to be the winners versus who are going to be the satisfied negotiators.
Both economists believe the Renewable Fuel Standard, or RFS, will continue to help agriculture.
The two industries, the petroleum industry and the ethanol industry, even though they fight tooth and nail, they've actually reached an accommodation right now. The petroleum industry is okay with 10% ethanol blend. They're okay with that right now. They've adapted to that, and there's no reason to expect that 10% blend, that level of output that we produce with cornstarch ethanol, to go down. It should be able to at least grow up to the 15 billion gallons mandate and at least stay there.
Valuable manufacturing employment could grow in rural areas, but is fighting both economic and demographic tides.
Modern agriculture, modern manufacturing has been shedding labor. We've known this all of our lifetimes. They need less labor to produce more goods and services. 2/3 of our counties are losing population. They're not losing population because the manufacturers or the farmers in that area were doing something wrong. People are moving towards trade centers or to metropolitan areas to work, and it is slowly, very slowly, but inevitably leaving, that labor is leaving those rural areas. Thinking you're going to turn around, though, this rural out-migration because of federal or state spending or some magic market consequence isn't going to happen.
We're talking about labor shortages and serious labor shortages, particularly for skill levels. So Iowa and other states could really move ahead if you could get those young men to become trained to do welding jobs, electricians. Instead, they're not doing that. They're not going to the community colleges to retrain themselves or to educate themselves for these jobs. Businesses really need workers, skilled workers, and it's a crying shame.
Goss and Swenson both believe that wind energy will continue to grow in the Midwest in the near term. For Market to Market, I'm Peter Tubbs.
Barack Obama took 45 days to fill his cabinet in late 2008. Two positions remain open for the Donald Trump presidency: Veterans Affairs and Agriculture. The transition of power will dominate the news in January, and the thumbprint of the new leadership remains to be seen. We do know policy made news in 2016, as did other events outside any one person's control. Paul Yeager looks back at the year that was, 2016 in rural America.
El Nino was the house guest that wouldn't leave as the calendar flipped to January. The rainy weather pattern helped ease drought in the western U.S. At the start of 2016, 100% of the Golden State was in some form of drought. By year's end, the same figure dipped below 85%, led by improved conditions in Northern California.
You will kill RFS, and Iowa will have her fingerprints on the weapon.
As winter's chill settled in on reporters from around the world covering the Iowa caucuses, presidential aspirant Donald Trump led a cavalcade of candidates defending the renewable fuel standard. Ted Cruz, who would eventually win the Iowa caucus's Republican sweepstakes, was not invited to the summit based on past statements to discontinue the RFS. Trump would connect with renewable supporters this day and eventually use rural America as a springboard to a general election victory.
The RFS, which is Renewable Fuel Standard, is an important tool in the mission to achieve energy independence for the United States. I will do all that is in my power as president to achieve that goal.
While the political landscape rumbled all year, the ground in one southern plains state was also shifting. The Sierra Club sued 4 Oklahoma energy companies over claims fracking was leading to earthquakes. After more than 900 tremors above 3.0 magnitude in 2015, the process of wastewater injection moved to the center of the investigation and litigation in 2016, all while the ground kept shaking. A 5.8 tremor struck near Pawnee in early September and was felt throughout much of the Midwest. The Sooner State's government body charged with regulating the oil and gas industry ordered 37 wells near the epicenter to be shut down because of previous connections between injection wells and earthquakes. The Senate delayed in late February the markup of a bill to invalidate individual state rules mandating labels on food with genetically modified ingredients. Congress would kick the can past July 1st, the day a bill in the Green Mountain State became law. More lenient than Vermont's law, the Senate eventually reached a compromise requiring any foods that include GMOs to carry a text label, symbol, or an electronic label where information could be scanned and accessed via a smartphone.
This is something that my friends on the right do not necessarily like, and I know some of my friends on the left don't like, but it's right. And it's necessary now so that we can protect the people who don't know if this bill doesn't get passed, they're going to be paying more food for no more value.
In March, President Obama became the first U.S. president to visit Cuba since Calvin Coolidge. The administration aimed at normalizing relations between the two countries in hope of expanding trade. Obama also traveled to Vietnam and Japan in the name of enlarging the U.S.'s financial footprint in the Pacific Rim through the Trans-Pacific Partnership. The TPP was signed but never ratified by Congress. Both presidential nominees denounced the pact as being harmful to domestic companies. President-elect Trump has vowed to withdraw from the 12-nation treaty, which took 7 years to negotiate.
The TPP makes important changes to trade rules for agriculture, addressing the non-tariff barriers that reduce trade.
The president-elect campaigned under the banner of Making America Great Again through improving U.S. interests in trade deals. This included tariff talks with our major trading partners of China, Mexico, and beyond. Oil hovered around the $50 per barrel mark for much of the year as increased exports of U.S. crude helped keep a lid on world prices. OPEC announced a production cut that's still not realized. Winter settling in didn't deter activists in North Dakota over the Dakota Access Pipeline. Construction along the 1,200-mile route is nearly complete, except for a single-mile portion under the Missouri River. By December, the drumbeat of protest crescendoed and celebrated a decision by the U.S. Army Corps of Engineers to halt construction of the last mile. The usual calamity of weather involving floods, fires, and tornadoes plowed on this year. Drought in southeastern U.S. strengthened, while winter's chill started early in the high plains. A late summer deluge inundated portions of the Corn Belt, delaying harvest for some farmers. The fields dried enough to combine what's expected to be the biggest corn and soybean crop ever harvested. For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
Weather was the big story this week, with wetter conditions in South America and a dry, cold forecast in the Great Plains. For the week, March wheat improved 15 cents, and the nearby corn contract added 6 cents. A big rally Tuesday was mostly erased in the days after, as rainy conditions in Argentina may have been overstated. The soybean complex's March contract finished 7 cents higher. March meal followed suit, adding $5 per ton. In the softs, March cotton swelled by 78 cents per hundredweight. Over in the dairy parlor, January Class 3 milk futures declined 18 cents. The livestock sector finished mixed as the February cattle contract shed a quarter. March feeders dropped $1.60, and the February lean hog contract added $4.88. In the currency markets, the U.S. dollar index was off 72 basis points. Crude oil expanded 70 cents per barrel. Gold broke its 8-week losing streak to gain $18.10 per ounce. And the Goldman Sachs Commodity Index improved 6 points to finish the week at 397.75. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Dan, welcome.
Thanks very much. Glad to be here.
Before we get started, you can listen to our market discussion anytime by downloading our market analysis podcast on our website, iptv.org/M2M. Now, Dan, in your final market commentary for the year 2016, you sounded a positive tone, or at least not a bearish tone.
For looking ahead, absolutely,
Yes.
absolutely. You know, and in fact, it's hard to really back it up with a lot of statistics and facts and figures here right now. But of course, I mean, we're all kind of familiar with the old biblical adage that the first will be last and the last will be first. And you know, I think to a certain extent you can apply that to some of these markets here right now. I think you could look at the real high flyers we have this year, specifically the dollar, the equity markets, and you know, really have accelerated on a lot of hype, a lot of anticipation about how great things are going to be. And you can turn around and look at some of the markets that have really been depressed, not for invalid reasons. I mean, we have a phenomenal amount of wheat around the world. We have great excess supplies of corn, but we also have a record demand that's out there. And I think everybody tends to overlook that when we're so focused on supply. And, you know, I think a great example is if you went back a year ago right now, and you probably could not have paid anybody to say anything bullish about crude oil. And you know, in fact, the talk was, well, gosh, we just broke the $30 mark. We're going to go to $15 a barrel. And here we are over 50. Yes. To finish out the year. So it, you know, again, not that there's anything magic to that, but I think, you know, we tend to disregard why it's so bearish. Why could we ever move? Right. Well, if we knew those things, we'd all be, you know, multimillionaires, I guess,
yes.
too.
You know, bringing up crude raises a great point. We got a question here from one of our followers on Twitter. We encourage all of you to send in questions to us on Facebook or on Twitter. You can find us at Market to Market. This one comes from Alan in Chicago, Illinois, at Alan Dog. Alan wants to know, what is the trade as you look out to 2017 that equates to that $29 crude buy? Sure. Is there a trade in your eyes that is equal to that today? You
know, and of course it would be hard to back it up again with statistics and facts and figures, but I would tend to think when I look at all of the markets that are out there, what is the most undervalued in relationship to the other markets, to where money could start flowing into. And I have to come back into the wheat and the corn market. And again, to make something happen there, we're going to have to develop a weather issue somewhere around the globe, and that's global, I mean, certainly. But I think, if you look dollar for dollar, where we sit in relationship to historical ranges, again, like crude was a year ago when we were 30 and below, and nobody could even envision why on earth crude would, we're just producing so much crude, we're never going to get out of this, and it's just going to go down and down and down. And hence, we saw the rally we did.
That's right. The market is an active participant. People
Absolutely.
are going to change things. Speaking of changing things, Dan Hueber, wheat. Chicago wheat up 15 cents on the week. That's probably the biggest one-week move we've seen in several months to the upside.
Right. Yeah, and now granted, I have to take that somewhat with a grain of salt, although it would look like it was trying to set the stage to do a little recovery, but also keep in perspective that when you look at the managed fund money, that is the market they are so heavily short in yet, and they tend to want to take a little profitability at the end of the year because bonuses are paid out of earnings that are actually closed out. So I think that was primarily shortcoming by those people. But still, I don't think by any means did that turn them bullish in the markets. It just means they're a little bit less short than they were here a week ago. So
now, we do have another forecast for an Arctic blast to come rolling through the Great Plains, and there's very little snow cover. Would that combination of factors, should it come to pass, be enough to maybe get some more of these shorts out of the wheat market and light a little fire under it?
It could be enough to elevate it some. I don't think it's a market changer, but here again, too, I mean, I don't think there's going to be this massive one event type of thing that really changes the picture. It's all going to happen incrementally, and maybe it's a little problem with the winter wheat over the winter here, and then maybe we have some issues in Russia. I mean, and again, not that there's anything happening there, but I think they all just start compounding and piling on each other, and again, that's what makes some of those value buys to look back and say, well, gee whiz, why wasn't I taking ownership there? Because it did seem so undervalued compared to everything else out at this point in time.
So if I'm a speculator, would you be buying wheat here? Would you be buying a spring contract of Chicago wheat?
I would be looking at ways to get long in particularly some of those undervalued commodities. Okay. I personally have looked pretty hard at some of the ag-related ETFs that are out there that give you kind of a little more of a breadbasket of ag products. But yes, I mean, I think it is one where, if nothing else at this point in time, you're saying, I've got very limited amount of downside risk as compared to some of the other markets that if you were, thinking about getting long in the S&P 500 or thinking about getting long even in crude oil, these are all after, quite extended rallies, and, it would seem like the path of least resistance could easily turn the other direction.
Okay. Let's look at this corn market. We're up a little bit, back north of 350 here on the nearbys. How aggressive do you anticipate the American farmer to be post-January 1? Are we going to see a wall of corn coming into the market?
I don't think if it really hasn't moved already. I think most people have already done their tax planning. They did probably a very respectable job, maybe even too aggressive in some cases, but of selling soybeans this year. I mean, soybeans yielded bushel for bushel, of course, brought back a lot more revenue than the corn did. So I think a lot of guys tended to maybe have sold the beans, sat on the corn, use that for the cash flow needs. Now, granted, that doesn't make it go away by any stretch of the imagination, but here again, too, I think as we move into the new year, I mean, we are, and again, as I touched on initially, we are looking at record usage numbers. And, we're not seeing that back away. And it's granted, the export side of the corn market maybe has got some good optimistic figures out there at this point in time. But, when it comes to the supply side, it's a known entity. The USDA might make a few adjustments come January, but it's not going to be a earth-shattering move, I don't believe. So now the focus now turns to where is demand? Is that demand growing? Is it staying stable? And now what do we look at in the next year? Are we going to be able to produce successive crops as we have the last couple of years?
With all of those factors in mind, if I'm sitting here with old crop unpriced in the bin and a lot of unpriced new crop, am I just, would you anticipate that person to hold it and just wait and see?
That said, granted, can you hold it until July? Is that necessarily the right move? Now, I do think, yes, maintaining ownership in some fashion is probably a good thing. Holding that in physical cash, no, it's pretty hard to advise that. I mean, I think you play two things, in my estimation. One, the ranges. Right. When you look at corn right now, we get up towards 365, 370 in the futures. We tend to kind of price ourselves out. We get below 350, 340. 340, you tend to find value. So I think you basically work against that range. Plus, in your own local area, here again, we'll watch your basis levels, watch the amount of carry that's in the market if you have the opportunities. Move the physical, but if we do see moves back down to the lower side of those trading ranges, certainly come back in, use options, futures, whatever you're comfortable with.
Look at a call or buy a future outright.
And take ownership that way.
Soybeans. We went back north of $10. We had a little bit of a scare last week.
Sure.
North of 10. Same question. Should I be an aggressive seller here when the market's over 10? Or hold on, see how South America shapes out?
I tend to want to be more of a seller in there. And again, we have, particularly above this $10 area, have certainly recommended people go ahead and part with that. Here again, too, if something changes, South American production, yes, we can come back pretty rapidly and take ownership in a different fashion in there. When you look at South America right now, Brazil as a whole looks like it's out to a great start. Dr. Cordonnier is talking about 102 million metric ton crop, record crop down there again. Some touch and go areas in Argentina, but boy, certainly not to the point to where you can really get the bullhorns on at this point in time.
Okay.
So, and when you consider, soybeans, in fact, I was looking at it for my newsletter this morning, if year on year, we look at the corn market, we're down about a dime for the year. Pretty insignificant. I mean, really a small change. Compared to a year ago, beans are about $1.30 higher. So it's, those two are probably going to start balancing out here as we move ahead in time. Plus, right now, the economics would say we're going to see more bean acres, which some of the privates have already said. So, you've got a little more of an uphill push on the uphill struggle on the beans than I think you might on the corn market.
Yeah, I mean, this time last year, we were screaming for another $1.30, and here we got it.
There we go.
Real quick, Dan, just because it's the end of the year, what are your thoughts on the cotton market? Do you see a continued range-bound trade?
And of course, I am a commodity positive right now. I don't want to say bullish just yet, but I mean, I think when you look at the whole commodity sector as a whole, and I guess I've maintained this for some time, but if you look at the chart pattern and the CRB index, the Goldman Sachs index, or anything that's out there, it's showing this long base building pattern there. So I am generally friendly to commodities as a whole. Now, when you look at the economics of cotton right now, we would tend to say that we could see some more acreage in the South. We'll have to see how that unfolds. But boy, it has been just really a 6-month sideways pattern right now. We seem to be capped around 72.5 cents on the upper side, 67 cents on the lower side. Now, that I don't see us coming out of there anytime in the immediate future. But on the same token, that is generally a pattern you see at a bottom, not a top.
Okay.
So I think if weather at all comes into play, which I think we're probably setting the stage for some weather excitement this year, it's going to impact cotton just like it would corn or soybeans.
Okay.
So.
Commodity positive. Does that include the cattle market?
Now, longer term, yes.
Okay.
Short term, I think we're probably stretching the rubber band out just a bit here. I mean, we've really been up since the lows that were set back in October. Here again, too, when I was looking back over the last year, I mean, surprisingly, the hog market's actually finishing the year higher, where cattle, I think, were down about 18 cents a hundred, compared to a year ago. Probably, even with that great recovery, we're probably a little bit overvalued here right now. But I think the positives I see in the livestock, even though the hog and pig numbers, said we're going to have a 3 to 4% bump in the hog numbers next year, is that, yes, domestically, I think people in this country are feeling better about where they are. The unemployment numbers are good. They've got more money in their pocket. I think that translates into greater demand for red meats. So I think that could be the one thing that, here again, when we have this supply mentality, which is really what we've had in ag for the last year, we tend to ignore the demand. And it's nothing we want to turn our backs on right now.
I knew a lot of people this year that made prime rib at Christmas, more than I'd ever heard of in the past.
Absolutely.
So hopefully, but like you say, we might be getting a little toppy on this bounce. So probably worth looking at some puts here on the live cattle side.
Take protection maybe for the first quarter here, but
same story on the feeder cattle. Would you be locking in some protection in here?
I think so at this point. I mean, particularly if you're going to get the fats into any kind of a setback in there, it's got to have an effect on the feeders as well. But again, as I look out more towards summer months, I think we have some upside potential yet left ahead of us.
And lean hogs, Dan Hueber, you mentioned we're a little bit higher than we were this last year.
Correct.
It's been a crazy year in the lean hog market.
Absolutely.
We've gained and lost almost 50 points in this market.
Right.
Are we going to see that kind of volatility next year, do you think?
Maybe not quite as much volatility. I don't think we have the big washout as we did in that third to fourth quarter as we did, of course, in hogs and cattle both this coming year. I think one of the major elements, not only in domestic demand could come from the export side of the market. And granted, we know we've got this dollar at 14-year highs, and at least psychologically that's working against the export side right now. But here again, there's one of the markets I think that sometime in this first quarter of 2017 we're going to see a big peak in there. I think if that starts working the other way, that really could play well into the livestock sector.
So a peak in the U.S. dollar. Do you think we're close to that 305 we hit immediate post the Federal Reserve? Is that going to kind of be the top in your mind?
Well, it's not really showing any signs just yet that we're ready to turn around immediately. I think you probably have to get kind of post inauguration.
Okay.
Right now it's hard to define it much more than I think first quarter.
Okay.
I think by the end of March we'll have it in there. I look at it from the index value, I think, which is around 103, 104.
Yep.
I think it could maybe push up to as high as 108.
Okay. If the Fed, do we need to see consistent Fed interest rate increases to make that happen?
Right. I mean, if you get to the January meeting and they come back and say, well, it's really looking like, yes, we're going to follow through and probably see 3 more hikes this year. Yeah,
okay.
I think the dollar bulls to hang with it for a while. But boy, they're just, it's a hope. I mean,
okay.
Why haven't we factored this in already if we've been talking about it for
7 years?
Right.
So eventually it will turn back down, and that could be some opportunity in the livestock.
Absolutely.
All right. Well, Dan, we look forward to the next year, and we want to thank you so much for taking the time to join us at the final show of this year.
My pleasure to be here. Thanks very much.
All right. Well, that wraps up the broadcast portion of Market to Market. But Dan and I will keep the market conversation going, including answering more of your questions during Market Plus, which is available on our website. Now, while you're there, check out this week's M2M podcast. You can listen to part 2 of a year-end review with the producers of this program. And to be sure to join us again next week when we'll sort out the complicated world of the nation's visa program for seasonal agricultural workers. So until then, thanks for watching. I'm Mike Pearson. Happy New Year and have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.